So how is the US economy faring, and what do Americans think as they head to the polls? Joining us is William Lee, Chief Economist at the Milken Institute. Hi there, William. Always good to see you.
Thanks for having me, Gerald.
Of course. So inflation at a 3-year low, though hotter than expected. What's your reading overall into the figures released today?
You know, as a voter myself, I look at the numbers and say, I'm really happy that gasoline prices are about 12 to 15% lower than they were a year ago. But then I look at my electric bill and it's 3.5% higher than it was a year ago. My utilities are higher. And the cost of taking care of my car, my auto insurance is 16.5% higher than it was before. So inflation really is still with us. We've got some good news, it's coming down, but the things that really impact my life, that influence how I spend my money, those are still very, very high. Medical services, mechanic services, and so on. So we still have quite a set of issues facing us about inflation, and it really hasn't gone away.
Hasn't gone away. And of course, the 2.4% annual inflation increase is also slightly higher than the Fed's goal of 2%. When do you think that target will be met?
Well, it's going to be a while. I think the Federal Reserve itself doesn't expect the inflation to come down to its 2% target for about another year and a half, possibly 2 years. But remember, inflation coming down means that my cost of living continues to rise, but at a slower pace. I am still having a tough time making ends meet, especially for half the population who are working paycheck to paycheck and whose wages really haven't kept up with the pace of inflation.
Yeah, very important point to make there. And of course, we have to point out that the Fed tends to focus more on core inflation, which excludes more volatile food and energy items, like you just mentioned. So what does the 3.3% core inflation tell us?
I think the FOMC people have been speaking about this for quite some time now, to say that it's core inflation that gives us a lead as to where inflation is going in the future. The fact that it really hasn't come down, in fact, has a slight tick up on a 12-month basis, is telling the Fed we cannot have these huge interest rate cuts as much as the markets anticipate. The Fed gave us 50 basis points, half a percentage point cut in the last meeting. But going forward, I think everyone is pretty much, especially with these numbers coming in, will be ready to make a much slower pace of rate cuts, because they want to make sure inflation really does go to 2% quickly.
So that 0.5% cut that we saw in September, unlikely next month?
Very unlikely. In fact, I'm willing to bet anybody in the audience that it will not be 50 basis points at the next meeting. It'll be more likely 25 basis points. And if the numbers really come in and spook the Fed even further, they may not do any interest rate cut in December at all. So we may be surprised on the other side that markets are anticipating large interest rate cuts very fast, and it may come in the other way around.
I also want to quickly circle back to what you said earlier. You know, when you're talking about just energy costs and how much it costs to maintain your car, food prices also up 0.4%. We saw big jumps in eggs, butter, and this is one of the biggest issues since the pandemic. Any sign of these things cooling?
Well, I don't think that we can claim that these are price gouging. The insurance companies are telling us that the reason why car insurance costs have gone up is because the price of automobiles have gone up so much, they become much more complex to repair. Now, the price of eggs, I don't know. I doubt the farmers are gouging, but again, it's supply and demand. People have a lot of money to spend, and they want to have a nice breakfast. They're not going to make do with just oatmeal. They want something that has high protein. So the fact that people really do want to spend on good stuff means that good stuff is going to cost more.
William, there's also concern about the labor market, with jobless claims hitting the highest since August 2023. Now, we do know this is in the aftermath of Hurricane Helene, but is the overall jobs market problematic?
I'm glad you asked that. With the unemployment rates going down, unemployment rate is of 4.4%. It's slightly less than 4.5%. That's considered normal in overall history of the U.S. economy. But it rose quickly from 3.5%. And people are looking at that as saying, my God, the economy really is weakening because the unemployment rate rose so much. But we have to remember payroll growth. The number of jobs that are being put on payrolls has really grown tremendously. It's much faster than what is considered normal for the U.S. economy. So the labor market has sent us mixed signals. Unemployment rate rises because more people are looking for for jobs, and companies are putting on more jobs, but these jobs are not paying enough. People just aren't making enough money to make ends meet, and they have to get second and third jobs just to do that. And that's where you see a lot of discontent in the voter registrations right now. People are saying, I'm working like hell, I can't make ends meet, something is wrong.
Okay, so discontent with the voter. We're now less than a month before the elections.
Yeah.
And if people really do vote with their wallets, what might these latest numbers portend come November? What do you think?
Well, as the Milken Institute is a nonpartisan institution, so we don't favor one side or the other. But let's remember, the policies that are put in place have to convince the voters that they will address the heart of the issue, which is they're not making enough money to make ends meet. Whose policies will be pushing up wages and getting jobs in sectors that are high paying? Most of the jobs that have been created in the Biden administration for the last 4 years have been leisure, hospitality, and healthcare, which are relatively low paying sectors. What we need are more jobs in manufacturing, construction, and high tech office workers. Those are the ones that really pay a lot, but unfortunately, they are not the ones that are being created.
William Lee from the Milken Institute. A pleasure to speak with you as always. Thank you.
Thanks for having me, Gerald.